All right, well, good morning and welcome, everyone. Thank you all for joining us today. Our meeting on selling in a low interest rate environment, the story of Japan revisited. We've got a lot of great items to cover today. My name is Tom Vukovic. I head up the Financial Products Division at Insurance Network America. Our topic today and our intent is to provide you with some great insights on selling and maintaining your practice in today's low interest rate environment. We're also going to explore how you can protect your clients' income from low rates, what is the potential cost of waiting, and what this could mean for your clients. As always, we are committed to providing you with great topics, ideas, and tools to continue to help you build your business, as well as provide timely information that you need to know about. And our focus today will be just that. During our call today, if you have questions, please submit them on the webinar, and we will address them towards the end of the presentation. If you want to call us, and most of you have our number, 800-456-7999. So don't hesitate if you have a question after the call, and we'll be here to help you. At this point, I want to introduce Billy Boyles, who is the Director of Sales at Allianz Life of North America, and Billy's going to cover a lot of great topics for you today that will provide you with insights and also give you some great tools to use within your practice and for your clients. So, Billy, thank you so much for joining us today. We do appreciate you being here.
Thanks, Tom. I appreciate it, and thanks to Insurance Network for putting on this webinar, and thank you to all of you for taking time out of your day to join us. It's going to be a short webinar, so you can get back to work and get back to doing what you do best, which is meeting with clients and providing them with the two most important things that we can offer is principal protection and lifetime income. And I'm going to start there, and I'm going to end there as you see we go through this. Principal protection means more than ever right now, and as we go through these slides, you'll understand more of what I mean. But unfortunately, protecting an asset has become something that is not as common as we've seen in the past when rates were significantly higher. And then secondly is lifetime income. The vast majority of Americans today retiring have one single source of income, and that comes from their Social Security, and they lack a secondary source of guaranteed income. So they're left with withdrawing down on an account, or simply hopefully riding the waves of the markets to hopefully make it through the end of retirement. And as we have learned, hope is not a strategy, and when you only get one chance to retire, using hope as a strategy I think is a tough way to go with it, and I think it's a challenging way to go. But principal protection and lifetime income are two things that never change about our products. They're two things that we always have to offer, and I think that's important in your sales process that you build. It's important on how you present to clients. It's important in really the way you build your business to keep these at the forefront. If you're able to keep principal protection and lifetime income at the forefront of your business, your marketing never has to change, your sales process never has to change, and whether or not rates change from this carrier or that carrier, that's not going to affect your flow of business. If you're out there selling, the highest illustration, or going for the most accumulation you can provide to a client in an index annuity, that's going to change your story every other month. We've seen a series of companies change in the last 2 or 3 months. More to come this month, as I've seen in my emails the first couple days this week. Every company's changing to adjust to this interest rate environment. And if your sales process is driven by illustrations or it's driven by rates, your sales process changes every month or two, and that's a challenge to your own business that I would invite you to look over and look at to see, do I need to tweak things a little bit differently in my own sales process in order to make sure that what you're selling each and every day doesn't have to change, so your sales momentum is level, if not always rising, and you can affect your business rather than having external factors like interest rates affect your business. What we're going to go through today is selling in a low interest rate environment, the story of Japan revisited. Why is this revisited? I actually wrote an article on Are We the Next Japan was a title in 2011, and this wasn't, it was right after the crisis, and we'd started to enter, the 2% Treasury marks, and we were asking the question, could this sustain itself? And unfortunately, the fact has been proven that it can sustain itself, and we are in a low interest rate environment. So we're back to re-educating on the Japan story because of some of the things that have happened in Japan. And if you take a look at the U.S. Treasury, believe it or not, back in 1990, it was between 8 and 9%, and steadily decreasing over the last 25 or 26 years, even from past, this is turned to about 2013, extend that out, and we're still in the same environment. And you ask yourself, can interest rates go any lower than what they're at today at about 1.6? And I think is what it's at this morning. And an interesting thing from our actuary, and this is part of that cost of waiting, right? There's a reason why the Treasury is where it's at right now, because half the people think it's going to go up, but unfortunately half the people think it's going to go down, and that's what sets the price at 1.6. It's basic supply and demand economics, if you will. So again, half the people think the Treasury is going to go up from here, but half the people think it's going to go down. They're buying and selling on both sides of it, setting that price right in the middle at apparently 1.6-ish% of where we sit today. So for those who say rates can't go down, well, half the people think they are, and half the people think they're going to go up, right? So it's an interesting point in time where we're at today, and the answer really is you don't know which way that Treasury is going to go in the next few years. Can the record be broken? So I think we hit 138 at one point in time. Is that the lowest it can go? Back in 1968, Jim Hines ran the 100-meter dash, and he was the first human to break the 10 seconds in the 100-meter dash, and people thought that could never be done. Another record in the past that you might be familiar with is the 4-minute mile. People thought the 4-minute mile could not be done. They ran under a 4-minute mile in the Paralympics this year. So and they actually had a faster running in the Paralympics than they did in the actual Olympics. If you haven't read that story, it's a pretty interesting run. Pretty interesting one. I didn't mean the pun there. But many thought this couldn't be broken, but obviously 15 years later, broken by Calvin Smith, 9.93, and we all know the lightning bolt out of Jamaica, Usain Bolt, ran it in 9.58 seconds, and it has been beaten more than a dozen times in between there. So records can be broken. Interest rates can go further down. Do we at Allianz want to see that? No. Do you really want to see that? No. But in planning purposes, it's important to explore all options and understand that it certainly can go in the other direction. So Japan and the U.S. have a lot of similarities, going back to what happened to them in the 80s, in the 90s, and what happened to us in the mid-2000s. We both had an equity bubble, and we both had a housing or real estate bubble burst, essentially. We had inflated asset prices in both areas, and the bubble burst. And unfortunately for Japan, they have really yet to recover. They first hit under 2% in 1997. So 1997 was the first time they clipped under 2%. And in 2012, they had 78 basis points. And if you look at their Treasury today, Unfortunately, it is actually negative on the 10-year Treasury. So not only has it continued to drop, it has actually entered negative territory. That is what I'm talking about when I talk about principal protection today. I'm talking about sovereign countries that have good economies, that are some of the largest countries in the world. If you give them $100,000, at the end of 10 years, they're going to give you back $99,000 in change. Again, if you give them $100,000, they're going to give you back $99,000 in change after 10 years. Not only are you going to give you less money back, but how has your purchasing power taken effect during that time? How has inflation hurt your purchasing power during that time as well? Can your $99,000 in change still buy you $99,000 worth of goods, or can it buy you $85,000 worth of goods or $80,000 worth of goods? So unfortunately, we're seeing that across the world. This is a look at a few of the interest rates around the world today. So the U.S., and this is ballparking, right? We're sitting at about 1.5, 1.6 as of late. Italy, 1.23. Italy, with all of its issues and all of its debt problems that are far beyond what we're experiencing here in the United States, if you invest in a 10-year bond in Italy, you're going to get paid less than you invest a 10-year bond in the United States. Now, if I were investing money, I would think that investing in Italy is far more risky than investing in the United States. Now, shouldn't I get paid for taking that risk and investing in Italy? Apparently not in today's global economy the way it sits today. Canada, our friends to the north, sure they're good and safe. United Kingdom at 0.96. And then you have France, Germany, and Japan. France, 17 basis points. Germany, one of the third largest economy in the world, negative 15 basis points is what they're paying. So again, give them $100,000, they're giving you less than $100,000 back after 10 years. These are 10-year treasuries, and they're paying negative on the 10 years. Just keep my money safe and give me a little bit less back from what I'm at. So again, back to principal protection, that first principal protection. Are your clients aware that in other countries right now, you literally can't even get your money back after 10 years by investing in the safest spot you could invest in? You can't even get your money back. So principal protection 5, 6, 7, 10, 15 years ago didn't mean exactly what it meant. You could have went to the bank and got a 4% CD, which was FDIC protected. What can you get at the bank today? And this is back to the basics, but it's important to note. I think on a 2-year, I've seen, I looked at bankrate.com, and on a 2-year, you can, sometimes, get 1% sometimes on a 2-year. But on a 1-year CD, you're looking at 35 to 50 basis points on a 1-year CD. Again, with inflation exceeding 1 to 2%, what are you really getting out of that? So U.S. interest rates can't go lower, right? What we said before, 50% think they're going to go higher, 50% think they're going to go lower. So unfortunately, where we're at today, and I'll look and see exactly where we're sitting as we speak, we're up a little bit today, so we're at 165. So at a 165 Treasury, what do you think? Could they go higher or could they go lower? It was interesting, and this was just an exercise with our executive team. The question has been asked, do we think we're going to hit 2% or do we think we're going to hit 1% first? Which do we think we're going to hit first? And unfortunately, we really don't know the answer to that question. Think about where we've been in the markets, right? We're on about a 7-year, 6.5, almost 7-year bull run in the stock market, right? And a pretty steady run. A couple of hiccups here and there, but a pretty steady run in the market. We have an election coming up, which is very polarizing, and we're not going to get into anything about that, but it's very polarizing, and it could cause a lot of volatility moving forward regardless of who gets in and what happens. Just the uncertainty of a new administration could create volatility. So what happens if all of a sudden stocks take a hit? Where's the money going to go? Right? The money's going to go to bonds. So, the fact that we might think that rates can't go lower, they easily could. And remember the Japan, how long ago it was in Japan that they went under 2%? 1997. 19 years ago they first went under 2%. Now they're negative 20 basis points. So if we're sitting on the sidelines waiting for rates to come back, is that really what you want to be doing? I think one of the most important things of our products is actually a 3-year flexible premium on most of our 10-year products. And essentially what you can do today is open up contracts, get contracts started, and then you and your clients have 3 years to be able to add money into those contracts. So if you're working with a client that has, say, $200,000 that you're working with, maybe they don't want to put all $200,000 into a product today, but maybe they want to put 50 and lock in the opportunity to invest in today's dollars for the next 3 years. What happens if interest rates fall another 1% in the next 3 years? In 3 years, they can add more money into that contract they opened 2-3 years ago at that money's current rates. So that is a huge benefit. So if you haven't looked at that as an option in today's environment, I suggest it. And again, all of our 10-year products, frankly, have 3-year flexible premiums. So you have 3 years to add money later at today's dollar. And today's dollar, could be worth more, could be worth less. But guess what? If it's worth less, if all of a sudden rates are that much better in 3 years, open a new contract. You don't have to add it, right? Just open a new contract. But you're essentially hedging your interest rate bet by opening contracts today. So if you haven't been using that technique, I would certainly use it as we go along. Again, looking at Treasury rates over the last 20 years, if you will. An interesting note to this is after a while, in 2006, short-term rates and long-term rates were exactly the same. But after that, look at how short-term rates have changed during that time. So from 2006, rates were around the same, whether they were short-term or long-term. That's that flat or inverted yield curve that a lot of times after the fact we realize triggers recessions. But look at it today. So again, 162 on the 10-year Treasury today, 3-year Treasuries under 1%, 6-month Treasury, which is related to what they're going to be able to invest in the short term with the banks. You're sitting at 0.3, and then you have the 30-year. The 30-year is only at about 2.4 right now. So you have a steeper yield curve by before. So that 10-year spot is actually, oddly enough, it's a quality spot to invest and to get into. And that's that range of 7 to 10 years, which is where our products are at. You get enough yield to make some money, all right, to get something for your money, but you also have the benefit of not going out so long where you're 20 and 30 years out and open yourself up to that risk for that amount of time. So here's an example of the cost of waiting that we were talking about getting into. So cost of waiting. If you invested today and only earned 2% compounded interest for 10 years, that would equal $121,899, right? So pretty simple. 2% compounded interest 10 years, $100,000 turns into $121,899. Remember where we talked about short-term interest rates being basically zero. You leave it in the bank, you get 30 basis points or something like that. So if you were to wait 6 years, you would then need over 5% for the next 4 years to equal $121,899. So the question then for yourself is, if I put money on the sidelines for a few years, or my clients put money on the sidelines, it's a question for your clients. If they put money on the sidelines and they invest in in the banks and in money markets for the next few years, waiting for rates to get better or waiting for an opportunity to invest, do you really think the Treasury is going to go back, the short-term Treasury is going to go back to 5% in the next 5 or 6 years, knowing what we know about our debt, the markets sitting where they are at this point in time, the history of Japan, and also just the rest of the world's interest rates? How are we going to rise when, Japan and Germany and all those are paying negative interest rates? How are we ever going to get a rise in interest rates when there's so much demand for our dollar right now and so much demand for U.S. debt? Why would you go invest in Italy at 1.2 when you could invest in the U.S. at 1.5? That's the question everybody's asking right now. Why would you invest in Germany at negative 17 basis points when you invest in the U.S. at positive 1.5. You wouldn't, and that's why that spread will never get far enough apart. And that's why we think rates aren't going to increase for the next few years. So that cost of waiting is really going to hurt you over that period of time. So again, that principal protection, more important than ever when you're looking at negative interest rates across the world. So obviously, fixed index annuity benefits in any rate environment. I talked about the two that I think are most important here from a client's perspective: the principal protection and lifetime income. Certain clients can benefit heavily from tax deferral, which offers you obviously compound interest during that deferral time, and it helps your accumulation to get even better if you're talking with non-qualified money. If you're talking about people with chunks of non-qualified money, put it in the bank, guess what? Now they're paying all of a sudden taxes on that as it grows, and they're earning even less over that time because they have to pay taxes out of their pockets, watching that grow in the bank options as well. Lifetime income options, that's the most important thing we're talking about right now. And I know INA works a lot with Tom Hegna and brings them out, and he talks about mortality credits. Mortality credits are never going to go away in insurance contracts, right? They're in life insurance contracts and they're in annuity contracts. The longer you live, the more you benefit from mortality credits in annuity contracts. And also death benefits. We have a product, the 222, that offers a 15% bonus, 150% growth, and is payable out at death for non-qualified money for people who are uninsurable, or for qualified money, people who want to spread their death benefit apart. That is a great place to look at to invest the money. So for client objectives, if you want future income, we have a couple of products to look at for you, and I encourage you to call over to your INA marketer, call Cade, call Matt, call Jason, Shannon, Brad. Get a hold of them, and they'll help you to position exactly which product is the best. Our top seller is the 222. Our second best sellers are the Core Income 7 if you want a 7-year, or the 360. All of them are in the top 10 of FIAs in the business. 222 happens to be the top seller, but I think you'll find a lot of value in the 360 and the Core Income 7. And at this time, I actually want to show you a quick way to illustrate products via our website, and we actually have a 360 calculator. So this makes it easy for you to look at the potential power of our products even today. So we made some changes to guarantees, just like a lot of people have. Made some changes to rates and caps, but when you still look at our illustrations, we're still able to make you your 2.5 or 3%. And even though that doesn't sound like a lot, what are the alternatives? Where else are you going to get principal protection, lifetime income guarantees, and 2.5 to 3%, maybe even 4% growth on your index annuity? If you look at calculating initial premium, just put in the initial premium, whatever you want. There's a nice little slide bar here where you can actually slide back and forth to see the current age of the client. Maybe they're 57 years old. They want to take income 66, and they want to get just a predictable income. So calculate that. So the payout percentage at age 66 is 6.5%. 6.53% is your client's payout factor at age 66. Have you seen anything like that around the business today? 6.53%, right? Then look at the opportunity for it to grow. Not only, and this is something to dive into further details with your marketers, but our accumulation value actually affects what your initial income is going to be. That's unique within contracts today. So 1.5% growth in your accumulation value, your income actually goes up to $7,400. And with 3% growth, it actually goes up to $8,500. This is the compound annual increase you'll need in order to keep up with that. So are your clients confident they'll earn 5.3% in the markets, 6.8% in the markets, or 8.5% in the markets? If they're not, then it's certainly worth a shot to take a look at what you have. Let's do 63, and maybe they want to do 70. Calculate the difference again. Look at these compound annual increases they're going to need to keep up with these payouts. 5.88, 7.47, 9.05. Are they confident they're going to get that in the markets after paying fees? And then not only that, ours is guaranteed. Theirs is subject to market risk for the rest of their life. principal protection and lifetime income are two pillars of our business that will never change. And I offer, you to work with your marketers to create your own process of how do you make this the forefront of your sales process, and how do you make sure that what you're saying on a daily basis, your story never changes. Regardless of where rates go, regardless of where bonuses go, your story never changes day in and day out. That's what I see the most successful people in this business doing, is they've created a story that they can tell today, they can tell tomorrow, they can tell 2 years from now, and it's not going to change regardless of what external factors happen in the marketplaces. So take a look at that and see what you can do, and use this Japan story to better your story of principal protection, because it does mean more than ever today. When a company or a country like Germany doesn't even give you $100,000 back after 10 years, and they're in such a healthy economy, it's certainly a point of worry about where things could go as far as interest rates. So today's rates might be the best you can get. I know they don't look like it, but they might be the best you can get for the next 5, 6, and 7 years. It's odd to think about it that way, but it's worth it to think about it that way, because, again, we have contracts that you can open now that you can add in for 3 years. So when working with clients today, if they're on that edge, just get something in the contract, start opening these contracts up, and hedge your bets and have the opportunity to add to them for the next 3 years. So then, therefore, if interest rates do fall further, you're able to add money to that contract at today's rates. If interest rates increase, guess what? Buy a new contract. You're good to go when it comes to a new contract as well. So I want to thank you all for joining us today. We're right at our half-hour mark, as we mentioned. Thanks to INA again for putting on a great show. They're a great partner of ours, one of our most loyal companies, and we can't appreciate them enough, the work they do for us, because it's you guys that are joining us on the phones today, and it's groups like INA that make us the #1 carrier in the business. So thank you guys so much.
Hey, Billy, thanks again, and I do appreciate you doing this kind of last minute. Everyone that's on the call here, thank you for joining us. It's really our focus to get this kind of information to you as quickly as possible. This is a brand new conversation that Allianz just had, and we wanted to bring it to you exclusively. So if you have questions, or if you have clients that you want to talk about, please don't wait. Give us a call. We will be following up with you. And again, our commitment to you is to continue to bring these types of ideas and information to you to help you pivot, help you continue to build your business. So I want to thank Billy again for joining us. And again, our number is 800-456-7999. Thank you, everybody. Have a great day, and we'll talk to you all soon.